the associate head at School of Accounting and Finance, and also the co-director for the Center for Economic Sustainability at Hong Kong PolyU. Today is our 11th past seminar, and our topic is the state of sustainable finance and sustainable merger and acquisition in APAC and China. We are so happy to have three excellent, outstanding speakers, both from academic and from the financial industries, as you can see from Professor Xintong Zhan from Fudan University, and we also have two industrial speakers from EY and ING. So let me first introduce our academic speaker, Professor Xintong Zhan. Professor Zhan is a Lin Da-san Chair Professor at Fudan University. So Professor Zhan received her PhD in finance from Chinese University of Hong Kong and her bachelor degree from the Peking University. Her research interest exactly the same as our topic, the ESG and sustainability and the implication in the capital market. So Professor Zhan has published numerous number of articles in top finance and economic journals, including Management Science, JFE, RFS, JFQA, all our top finance journals. And she's really a rising star in our field and also an expert for ESG research, especially the implication in the capital market. So we are so lucky to have her to give her insight. Okay. So without further ado, let's welcome Professor Zhan to give her research update about ESG and its implication in the capital market. So the floor is yours, Professor Zhan.
Thank you so much, Professor Wu, for introducing me. Yes, I would like to share my screen, but yeah, brilliant. Thank you so much. So thanks again to Professor Wu and PolyU for inviting me. I hope you can all hear us. Yeah, so this is a joint work with Jay and Elaine. They now both with CUHK, but Jay will join PolyU soon. So you will have another guy doing ESG and also capital market studies. So Jay will join PolyU very soon, and Elaine, our student at Chinese University of Hong Kong, will join IE Business School in Spain very soon. Another co-author is Ami Gao from University of Lausanne and Swiss Finance Institute. I'm Xintong Zhan. I'm now with Fudan University. So as you can see from the title, in the paper, we are trying to look at the ESG risk premium. We are trying to measure that premium in the options market. So options are the most important derivatives of stocks. Now, let me get started. All right. So this figure shows you the number of signatories and the total of assets under management of those signatories of the so-called PRI. So PRI is a network that was initiated by the United Nations. So once you sign this PRI, you become committed to ESG or sustainable investment. All right. By the end of 2021, there are around 4,000 signatories who signed the PRI, indicating that they are going to be responsible investors. And together, they manage around 100 trillion US dollars as assets under management. And by today, I think PRI has already celebrated 4,000 signatories. So there is really a fast growth of the so-called ESG investing. So if you ask the institutional investors, why do you want to be responsible? Why do you want to invest in ESG related stocks? Which means you would like to pick stocks with good performance in environmental and social and governance performances. And why do you want to see that? And some of you may give you the answer because they want to enhance the value of their investment. And I believe a majority of them will also talk about the risk management. All right, because the poor performance in environmental, social, and governance of firms may increase a lot of risks. For example, you can think about litigation risks. And here I'm giving you one example. In 2015, there is a group of around 2,000 Zambian citizens, and together they sued this KCM company and this is a company actually based in UK. The reason they are suing this company is that the company repeatedly discharged toxic emissions from their operations to the water courses used by those citizens. So this is an example of the litigation risks. And you may also imagine that there could be some regulation risks. We have been talking about carbon tax, right? And we kind of know that there is a relation between carbon emission and also the global warming. You can think about Paris Agreement, and you can think about all the regulations that a country may impose on those firms with high carbon emission. So this is the type of regulation risks. And reputation risks, they are related to corporate culture, for example, and there could also be supply chain risks. So if a firm is doing really bad in ESG performance, they may have some potential to have those risks. And therefore, such risks may increase the uncertainty of stock returns. So you can imagine the content of time and timing of regulation changes is very difficult to predict. So we will talk about carbon tax, but we never know how much we should charge the company for emitting too much carbon, and when should we impose such kind of regulations. So they are difficult to predict. And you can also think from the perspective of reputation. So this is kind of intangible assets, right? So it is quite difficult to measure the damage of reputation. So those kind of risks are related to the downside, but there are also kind of upside opportunities. According to a new paper by Lauren Cohen, so this is a professor from Harvard University, Lauren Cohen and his co-authors actually argue low ESG firms may have upside opportunities. So what is the rationale behind it is if you are going to divest from a mining company, for example, and the company face the divesting, they have to change, right? They have to transform from a high carbon emission firm to a low carbon emission firm. And how they are going to do that, they may actually innovate. So it's possible those low ESG firms have the incentive to innovate and transform from a low ESG firm to a good ESG firm. And therefore, they have upside opportunities. So all those upside and downside risks actually would increase the uncertainty of stock returns. And now we are going to look at those kind of risks in the options market. We want to ask the following questions and provide answers. So first of all, do option investors recognize those ESG related risks in the options market? And secondly, what is the pricing of uncertainty associated with ESG in the options market? So we hope to use options as a kind of platform to measure the ESG related risks. And why we are so keen to do such kind of research, because if you think about the options market, some of you may think them as insurance, right? So you buy options, for example, the put options. The reason is that you would like to purchase kind of protection against the downside, right? Yeah, for such kind of derivatives, if we could see the pricing of uncertainty associated with ESG, we could answer whether the investors are willing to pay a premium to hedge against the uncertainty. Or if you focus on the upside opportunity, there could be some kind of speculation. But in any case, we hope to measure the kind of premium that investors are willing to pay in the options market. And some of you may wonder why we focus on the options market. Yeah, we have bond market, we have stock market, but why options market is a good one to study? The reason is that option market is an ideal laboratory to study the pricing of uncertainty. So the price of options is extremely sensitive to uncertainty or risk, if you would like to say. For example, there are several kind of top journal papers by Kelly, Pastor, and Varanasi. So they are all from kind of Chicago. So at least the Pastor and the Varanasi are from the Chicago booth. And what they found in their paper is that if you have an option and the option's life spans over a political event. So yeah, for example, over an election event. In this case, those options are going to be more expensive than other options whose life doesn't span over political events. So what does this kind of results mean to us? It means political uncertainty or political risk is priced in the options market. And parallel to their study, we are trying to study whether the uncertainty associated with ESG performance are going to be perceived by the investors in the options market, and how are those uncertainty ultimately priced in the options market. So this is kind of our motivation. Before I go into the details and talk about the technical things, I would like to show you a few figures, and then I think most of you could already understand what we are doing in this paper. So this is a figure, and the y-axis is about the implied volatility. So for those who are not so familiar with the options, you can imagine the implied volatility to be the price of the options. Okay, so if an option has a higher implied volatility, yeah, their price, the option is more expensive. Okay, so this y-axis shows the implied volatility difference between low and high ESG stocks. So you can imagine this is the price difference of options between low and high ESG stocks. You can imagine this cap to be the relative expensiveness. Okay, as you can see, they are always positive. Okay, it's always above zero, indicating that firms with low ESG performance, they have more expensive options. Their option prices are relatively more expensive. And over time, we actually split the sample into 3 periods. And what this PA here, this PA is Paris Agreement. So Paris Agreement can be imagined as a milestone in climate change, right? So yeah, in December 2015, actually a lot of countries and they gather together and talk about how we are going to combat climate change. And therefore they signed this Paris Agreement. Okay, and after the signing of the Paris Agreement, people seem to expect a more stringent regulations against the carbon emission or ESG performance. And what you can see in this figure is that before the Paris Agreement, the price difference between low and high ESG firms are actually kind of flat. It's around 10%. However, when the Paris Agreement become effective, when investors or public expect there could be more kind of stringent regulations, investors are simply paying more attention to climate issues, the price gap increases a lot, okay, from 10%, around 10% to 16%, which is the highest level in this figure, okay, indicating that options of low ESG stocks are becoming more expensive when the Paris Agreement is effective. Okay, and in the US, there is another event, which is the withdrawal of the Paris Agreement. So we know that President Trump didn't believe in climate change, and under his administration, US actually pulled out from the Paris Agreement. And after that, investors' expectation about climate changes and potential regulation changes kind of decrease or get eliminated. Okay, so what you can find is that the price gap between low and high ESG stocks, of course, this is the options price, they revert to the normal level, which is around 10%. Okay, so with this figure, we hope to show you that options of low ESG stocks, they are becoming more expensive compared to high ESG stocks after the Paris Agreement. When investors are paying more attention to climate changes, when they expect more regulation changes or regulatory risks, there could be a pricing effect in the options market. So this is the first figure I would like to show to you. Yeah, and some of you may complain, well, the Paris Agreement is really a big shock, but it is only a one-time shock. So there could be some other kind of time trend going on which can contaminate our results. So we are going to look at another kind of event, which is the Greta Thunberg's speeches. Yeah, this is the Swedish teenager who is very famous for challenging the world leaders for not doing much against the climate changes. And we are going to look at her speeches. So we select 10 of her most famous speeches, and we are going to look at the days around her speech. Okay, so 10 days before her speech to 10 days after her speech. Again, our interested variable will be the implied volatility difference, so price difference in options between low and high ESG stocks. And similar to our figure earlier, there is a positive gap. Options of low ESG stocks are going to be more expensive than options of high ESG stocks. However, this price difference becomes kind of get enhanced after the speeches of the Greta Thunberg. All right, so the positive gap gets bigger after Greta Thunberg's speeches. So investors are paying more attention, and not only investors, the public, the world is paying more attention to climate changes. And in such case, options of low ESG stocks become more expensive compared to high ESG stocks. Yeah, using this event, which is Greta Thunberg's speeches. All right. So using two climate-related events, I'm showing you when investors are willing to perceive the risk will be priced in the options market. But ESG is not only about climate, right? It is about environmental, social, and corporate governance. So I'm going to show you another figure, which is the Me Too movement. So Me Too movement is about gender equality, right? And this is in 2017, right? October. So a lot of people started to tweet on Twitter with the hashtag Me Too, to support women around the world, actually. So this is about the social kind of event. Again, what we are doing here is to look at the price difference of options of low and high ESG stocks and see how the options market react to the Me Too movement. We are looking at 10 days earlier and 10 days after the event. And similarly to what I have shown you earlier, there is a price gap, but this price gap gets larger after the Me Too movement. Again, when people are paying attention to the social issues, firms with low ESG, their options are going to be more expensive. All right, options of low ESG stocks become more expensive compared to high ESG stocks after the Me Too movement. So with those three figures, I think you already know what we are doing in this paper, right? Let me summarize the main results in our study. We show that the option expensiveness as measured by implied volatility is higher for low ESG stocks. So low ESG stocks have more expensive options. And our objective, as I told you earlier, is to measure the risk premium. And we are using this delta hedged option returns, which I will explain a little bit later. But the intuition is that options are derivatives, and we don't want the price movement in the underlying stocks to contaminate our results. That is the reason we are using this delta hedged options. So they are immune to the price movement in the underlying. So with this delta hedged option returns as our interested variable, we show that those returns are lower for low ESG stocks. So this is easy to understand. The high price, the lower return. And all components of ESG, environmental, social, and corporate governance, they all contribute to option pricing. Okay, it's not only about climate change or carbon emission or environmental performances. And the results get heightened after the announcement of the Paris Agreement, after the speech of Greta Thunberg, and in the aftermath of the Me Too movement, just as I showed you earlier in those three figures. Okay. And why investors are paying ESG premium? Because they want to hedge volatility, jump, or even higher moment risks. And because of the time limit, I'm not going to talk about this part in details. And we also find the results has a very large cross-section variation. So the results are actually stronger for firms that are closer to the end consumers. For the firms that facing severe product market market computation and for the firms with higher investors' ESG awareness. While you can also think about from a risk management perspective, we actually find if a firm is actively doing hedging, in this case, the effect of ESG on option pricing will be lower. Okay, so we will talk about those kind of results in details later. Now, let me briefly talk about the data. So how we are doing this research? We rely on the ESG data from Thomson Reuters SS4 data. Okay, yeah. So some of you come from industry, and you may find different data provider actually provide quite different ESG ratings. So we also find that in the academic research. So different ESG providers, their ESG ratings for a certain firm kind of have a lower correlation, indicating that those ESG providers are using different kind of assessment method, or they are using a different rating method for the firm. Okay, so our main database in this paper is Thomson Reuters SS4 data, but we also conduct a lot of robustness. So we look at least 4 or 5, I don't remember, alternative data providers, and we find our results hold. So we don't need to worry about the low correlation among data provided by different data providers. Okay, and for this data, it covers S&P 500 at the beginning, then it gets expanded to Russell 1000 index. So we have sufficient coverage to do this analysis. The options data, it comes from the option metrics. And using this data, you can find daily closing, bid-ask quote, trading volume, and open interest of each option. This is like the number of shares outstanding in the stock market. And for this implied volatility information, we directly get it from the option metrics volatility surface. So you don't need to calculate by yourself, just look at the data. They already provide the implied volatility information, which the data provider actually calculates from the Black-Scholes model. Other than that, we have kind of standard crisp computer stat data, but yeah, they are quite standard. So I'm not going to talk much about it. Now, let me be a little bit technical and introducing the data hedged option returns. You know that options are derivatives, so their price are kind of affected by the price movement in the underlying, which is the stock. Okay, so if we don't do anything about the option return, it is possible that we are just capturing the price movement in the stock market. And therefore, we have to do some data hedging to eliminate the effect of stocks price movement. And we are going to follow Bakshi, Kapadia 2003 and our co-author Jay's paper in 2013. So in those papers, the authors actually are the pioneer in this literature, and they show that you can do data hedging following their procedure. So at the end of each month, we are going to collect a pair of options. So a pair of options means a call and a put. And those options should be most close to at-the-money options. Okay, and they will expire in 50 days. They are standard options. So what do we mean? If you are going to construct your portfolio in the end of January, for example, in this case, those options are going to expire on the 3rd Friday or 3rd Saturday of March. Okay, so they are standard options. According to the literature, such kind of options are most liquid, and their price are likely to be more kind of accurate because of the high liquidity. So how do we do data hedging? If we take call option as an example, in this case, we are going to buy one call option, and we are going to rebalance it every day. And specifically, every day we are going to buy the option and sell data unit of stocks. Okay, so every day we open the position, close the position, and then on the other day we do this again. And therefore, we will have a time series of those gain from our kind of a transaction. Okay, and this actually shows you the gain, the dollar gain. Okay, so the gain from buying option, and this is the selling price when you close it, okay, and the gain from selling selling the stocks, okay. And if you have anything left as the money, you are going to earn a risk-free rate. Okay, so this is a little bit complicated, but the intuition is simple. You want to take out the effect of price movement of the underlying, you are going to do this data hedging. Okay, so adding up those gains together, you have the 1 month data hedged gain. And to make it comparable across different stocks, okay, some stocks just have more expensive options and their price, the stock price are also higher. In this case, across stocks, the gain, the dollar gain is no longer kind of comparable. In this case, we are going to scale it by the initial investment. So what is the initial investment? This is the gain from selling delta unit of stocks, and this is a cost of buying a call option. Okay, so and this number is going to be positive according to the data. So you have a comparable kind of return across different stocks. For put options, you can do it in the similar way. And how do we interpret this kind of return? So what does it mean? It means if you have a more negative delta hedged option return, in this case, the option is more expensive relative to the underlying stocks under the Black-Scholes model. So according to Black-Scholes model, this delta hedged return should be 0. Okay, but in reality, if you look at the data, look at our data and also the data in the literature, you will find the delta hedged gain, no matter it is for call or put options, they are going to be negative. Okay, they are going to be negative, indicating that options on average are more expensive compared to its underlying stocks using Black-Scholes model. So I have been asking industry people about this, and they also confirm that. So investment banks, they write options, and they write options with a premium, indicating that they are charging a premium to the option buyers, and therefore options are going to be more expensive. And indeed, this is actually a quite profitable kind of strategy by investment banks. Okay, even though they are all negative, if you look at the standard deviation of those data hedged gain or data hedged returns, there is considerable kind of variation across stocks, indicating that even though on average the options are more expensive, some stocks have more expensive options compared to other stocks. So there is a lot of variation. Okay, it's the same thing for the put options. And what are the stocks in our sample? There are large firms. Okay, so you can see this institutional ownership is high. It is around 80%, and analyst coverage is also high. So this is a sample which are likely to be the index, and they are going to be more liquid, and they are going to be more transparent. All right, so this is sample. Now let me talk about how we actually confirm our conjecture. How do we find a relationship between ESG and option pricing? We are running this Feynman-Macbeth regression. Okay, so yeah, it's a little bit technical, but we want to find a statistically kind of reliable relation over time. Okay, so it's not only about cross-section, but it's also about time series. Okay, and remember, this delta hedged gain is kind of the return of buying a call. What does it mean? It means if an option is more expensive, this gain will be more negative. All right. And a good ESG stocks are likely to have a cheaper options. And therefore, what we expect here is a positive kind of relation between ESG and delta hedged gain. And do we find them? Yes. So we can have different kind of empirical specification, but the message is the same. So a firm with good ESG score will have higher delta hedged gain, indicating those options are going to be cheaper. Okay. And how do we interpret those numbers? If we increase the ESG score from 25 percentile to 75 percentile, the delta hedged gain will increase by 0.32% for call options. And this 32 basis point is equivalent to around 15% of the standard deviation. So it is a little, yeah, the economic magnitude is considerable. Okay, so this is our way of establishing the kind of statistical relationship. All right, now let me talk a little bit about this Paris Agreement. So if our results are correct and they are indeed driven by ESG performance, but not by other kind of correlated variable, for example, you can imagine a good firm, a firm is good ESG, they could also be a larger firm, right? So larger firms are going to have cheaper options, then our results are going to be contaminated by firm size. And in this case, we want to make sure that ESG is the driver behind our finding. That is why we focus on this Paris Agreement. And according to our conjecture, we would expect the impact of ESG on option prices to be amplified after the Paris Agreement. Okay, so this is intuition is simple, right? So when investors are paying more attention, they would like to perceive the risk. The effect of the risk in the options market in pricing should also be kind of amplified. And the effect should also be mitigated after the announcement of the withdrawal. So when investors believe, well, this is not the case, we don't need to worry much about it, the pricing impact should be vacant. Okay, so we are going to run the regression for 3 periods, which is before the Paris Agreement, in the Paris Agreement, and after the Paris Agreement, which means after the withdrawal from the Paris Agreement, and see how this ESG score affects the data hedged option returns. So before the Paris Agreement, the effect is about 0.17. Okay, and in the Paris Agreement, the effect gets at least doubled to 0.43. And after the Paris Agreement, actually the effect gets weakened and even reversed to a negative level, which is negative 0.15. Okay, so you can see there is kind of a reverse reshape here. When people are paying more attention to ESG issues, the impact of ESG on option pricing gets much enhanced. Okay, so it's the same thing for the put options. All right, so with this Paris Agreement, we show you this effect indeed comes from the ESG performance, not about other things, for example, size or other kind of profitability, for example. All right. Due to the time limits, I'm going to skip this. Now let me quantify the magnitude of ESG premium. What is the magnitude of ESG premium? We are going to follow the standard asset pricing literature when they construct the factors. Okay, so we are going to form portfolios. So we form portfolios according to the ESG scores of the underlying. Okay, so 5 portfolio, P1 to P5. P1 contains the stocks with the worst ESG performance, and P5 contains the stocks with the best ESG performance. And how we are going to measure this portfolio return? Yes, we have the daily rebalance, the data hedged option returns, which I just introduced to you. So this is not stock return, but the option returns. So we take an average, value weighted or not value weighted, the results are kind of similar. Okay, so you can see the average return, this is portfolio return, kind of increased monotonically from P1 to P5. Okay, it means the price of those options are becoming cheaper and cheaper. Okay, the returns are becoming more and more positive, okay, or less negative, and leading to a spread of around 0.28% every month. Okay, so this is going to be the ESG premium in the options market in a very conservative way. So around 30 basis points per month. This is the premium that investors are willing to pay. Okay, so to make sure this premium is a premium about ESG, not about other kind of risk, we have controlled for different risk factor models exposure. For example, we have 6-factor model and 7-factor model in which we further control for market volatility, given this is related to options, okay? And our results kind of hold. And if you look at the put options, the magnitude is a little bit enhanced. This is also consistent with the notion that put options are more likely to be the insurance. Okay, so using a very conservative way, we rebalance it every day. We have a premium of around 30 basis points. But actually, you can also do that for straddle returns. Then the results will be different, but it will be larger, but still telling you the same story, which is options of low ESG stocks are going to be more expensive. All right, brilliant. So do investors really care about ESG? Do they really hedge? Do they really speculate? Well, unfortunately, I couldn't distinguish those two kind of demand, but at least I could show you some evidence from the demand side. Okay, so do we have a higher demand for options of low ESG stocks? We could make use of this ISE data and to show you the results. So specifically, we are going to measure the demand using signed option trading volume, which is defined as the total open buy, open interest, minus the total open sell, and scaled by stock trading volume. Okay. Once again, we are going to form portfolio to measure, but the dependent variable will not be return. It will be the demand for those options. Well, as you can see, the demand kind of decrease with the ESG performance. Okay, for the low ESG stocks, there is a higher demand for their options because investors would like to hedge or would like to speculate on such kind of options. But for the firms with very good ESG performance, the demand for options are going to be lower, leading to, again, a very significant long-short difference in the options demand. Okay, and because of this high demand, you can imagine the demand push up the price. That is the reason why we have a more expensive options. All right. So the underlying channels, I'm going to briefly talk about them and then conclude. Okay, so you may imagine the ESG performance tend to be more important for firms that are closer to their end consumers. So this is easy to understand. For example, I use cosmetics and pay attention to whether the cosmetics firms are using animal tests, for example. Okay, so the effect of ESG performance on option prices actually are more important in industries that depend heavily on the trust of their end consumers. And secondly, you can also think about market competition, product market competition. I think if you are doing marketing or management or strategy, you probably will hear some kind of argument that ESG performance is a competitive advantage, right? And indeed, we find the results, the effect of ESG on option pricing tend to be stronger in competitive industries. So this is about the nature of the business. And secondly, we look at the investors' attention to ESG. Do they care about ESG or not? So our first kind of cross-section variation comes from the location of the firms. We know that different political ideology kind of have different implications on ESG. And Democratic leaning voters care more about social performance compared with the Republican leaning voters. And we indeed find that firms that are located in blue states, they are going to have more kind of higher marginal value of ESG on option pricing. And you can also think about the questions the investors ask in the conference call, and we find when investors ask more questions related to environmental issues, the effect of ESG will be stronger. And last, corporate hedging policy. If you believe this is a risk management story, in this case, firms can actually hedge the risk related to ESG by doing some hedging, and therefore the effects of ESG on option pricing will be lower. Okay, so because of the time limit, let me simply conclude. We find ESG uncertainty is indeed priced in the option market, and the option prices reflect the market consensus on ESG uncertainty, and therefore options of poor ESG firms, they are going to be more expensive, leading to a higher implied volatility and lower delta hedged returns. So we look at a few shocks to show that this effect indeed comes from the ESG performance of the firm. All right, so thank you so much for listening to my presentation. And again, I thank PolyU, thank Professor Qiang for inviting me. Thank you so much. All your comments will be welcome.
Professor Zhan, thank you so much. Thank you for sharing your interesting and important research with us. I think your research is very important. I guess that has implication for the capital market, for the option market at least, right? So I also do some research on the ESG related issue. So one topic I'm doing currently is ESG sentiment. the market sentiment for ESG has been, changed over time. So how the investor sentiment on ESG affect your option price? Is that any implication for that?
Yeah, I think this is brilliant question, Professor Wu. Yeah, so the ESG sentiment over time is also changing. It's kind of related to attention, but not the same as attention, right? So I don't know a very clear answer to your question because I didn't see the measure. But one thing I know is that if you look at our sample and look at time series or cross-sectional variation, you will see that when investors are paying more attention to ESG issues, the pricing impacts will be stronger. So I think the sentiment measure, would have a similar effects, maybe stronger. We can talk even later. Maybe we can incorporate your measure. Yeah.
I agree. So I saw you did that in cross-sectional test. That's well, excellent. So because I'm not familiar with option, it's a little bit complicated. A more simple question is, so you look at option market, are there any direct implication for stock price? It's like more simple question, right? Yes. So we can do the farmer French, we sort the ESG stock and see whether there are abnormal return for high ESG. Yeah.
Yes, that is another brilliant question. So people care more about the stock market, right? Actually, if you look at the data, the results is not very clear. So if you look at this sample period, actually there is no very clear results. And recent theory paper, they have some theoretical predictions on why ESG may have a positive or even negative impact on the stock price. Okay, actually it depends on whether investors are paying enough attention to intangible assets, right? For example, if investors haven't paid enough attention to ESG issues, they undervalue the value of ESG. In this case, there will be a positive. In this case, there will be a positive association, right? But there could also be negative association. For example, when the sentiment for ESG is too high, for example, everyone is trying to buy a good ESG firm. In this case, they may have pushed up the price of the good ESG firms to a price above the fundamental value. Then over time, the price must convert to the fundamental value. Therefore, there could be a negative relation. So the stock market is kind of even more complicated because it is highly affected by sentiment, as you mentioned earlier. That is the reason we didn't look at the stock market. Yeah, we want to take a more risk perspective and look at the uncertainty part, which is more clearly priced in the options market.
I agree. Thank you so much. Due to the time limitation, we have to stop your talk. We move on to the next industrial speakers. So we welcome Professor Lapman Lee to host the industrial speakers. Okay. So Professor Lee, please go ahead to introduce our speakers.
Hi, Professor. No, thanks very much for that. And can you turn your cameras on with Sammy Koo from EY? She's a partner and good friend, a partner at EY-Partenon. Hi, Sammy. Good to see you here today.
Hi.
Hi. And we also have Andrew Chu from ING. Can you put your hi, Andrew? Nice Hello, background, by the way. We have Andrew with us here today. He's a director in sustainable finance. So what they will do a presentation first before we go into a panel discussion around the wonderful world of sustainable finance, around the importance of ESG in M&A transaction. I think we had good years in 2021 in terms of volumes around sustainable bonds, social bonds, sustainability-linked loans, M&A deals. So over to you for the presentation first. Will you share your slides, please?
Let me share my slide first.
Okay, thanks. Looking forward to hearing from you. To a panel discussion afterwards and Q&A. So look forward to your presentation, Sammy.
Okay, thank you, Lapman. Hi, everyone. Thank you, Professor Lee, for the introductions. Good morning, everyone. I'm Sammy Koo, a partner of Ernst & Young's Strategy and Transaction team. And today, I would like to talk about the emerging trends and the relevancy and the development of ESG in the M&A markets. So let's look at today's agenda. We will go through the following items, including the current ESG landscape in the M&A market. So how does ESG apply or relevance arise in the M&A market? And also the role of ESG in M&A deals. So where does ESG have a role throughout the M&A life cycle? And we would also talk about the challenges and opportunities in deploying ESG in the M&A deals. And then we will have a sort of a deep dive of a case. I would like to share some case study, that we have done for ESG due diligence, and also briefly talk about the expected futures of ESG in the M&A market. Okay, so as you can see this graph, you might all know that climate risk is regarded as a global challenge to the environment and economies. It is no longer causing, only causing negative impacts solely on the environment. It also affects our living quality and business activities. Previously, you might thought that storm is just a natural disaster or event, under the environmental cycle. But, due to climate change, you might, like Hong Kong, we have witnessed more frequent flooding and typhoon. We just have one, last weekend, right? For example, I think you also recall flooding in Hanfacun, in 2018, which is potentially caused by the rise of sea level, threatening residents' life and damages to the seafront residential flats or commercial flat, and hence, potentially lower the asset value in the long term. So I recall I have a client, he told me that, he's unable to get financing, to acquire a commercial building. Then you might ask yourself questions, commercial building, a bricks, normally, it's quite a typical, good collateral, for acquiring financing. But at the end, because of the commercial building has been previously been flooded, so that's why no FI is willing to give financing to my clients. So you can see that, the climate change is an issue, that is inevitable. So climate science also advised that such adverse effect will only deteriorate if we don't make any change to it. So in 2021, a report issued by the International Panel for Climate Change, IPCC, strongly suggests that global warming to be limited to 1.5 degrees Celsius compared to pre-industrial levels, and warned that any temperature rise greater than that may cause major environmental impacts. So, for example, if we take the increase of 2 degrees Celsius as the example to compare against 1.5 degrees, what will happen? As you can see from the chart, a rise in the sea level, maybe by additional 10 centimeters, and more severe and frequent heat wave across the globe. Just so you can see, like late April or early May this year in India and Pakistan. So they have record high temperature of 46 degrees Celsius and 50 respectively. Can you imagine? Can you bear such extreme heat circumstance? And also maybe high risk of droughts in Mediterranean regions, decline the coral reef as much as 99%, or significant decrease in global fish catches. And also maybe, significant increase in people who might experience poverty that relates to climate change impact. Then you might ask yourself questions. What do this mean to human beings and living environment? For instance, the rise in sea level means that your property in Maldives, or if you want to plan a trip to Venice, maybe gone for good. So you might no longer see such, a nice place. And maybe not able, and you go scuba diving, you might not be able to see the beautiful coral reef, etc. So that means apart from you can't enjoy, the natural, environment, when you do the scuba diving or whatever, no coral reef means that no protection to the coastal lines from storm and erosions. This really poses significant impact on our safety and living quality. So let's talk about, today's topic. How does it, I'm not scientist. I'm not going to go into the details of what will happen, on the climate risk today. But I would like to share, how does it relevant to in the M&A market? The climate change issues has increased a lot of awareness, in the community and business activity, like the M&A market. It plays a very crucial role to mitigate the relevant risks with heightened risks and new opportunities arise. Like cons always have two sides. On the one hand, it has the risks such as according to the World Economic Forum's global risk report in 2021, more than half of the top 10 risks across likely to happen or impact is ESG related. So including climate action failure, extreme weather, biodiversity loss, natural resources crisis, human environmental damage, and I think all of us still experience it is since late 1920, infectious disease like COVID. So as I said, can't always have two sides. So we have the risk on the one hand, it also have opportunities on the other hand. Meanwhile, the rise of ESG had a lot of opportunities for business to expand and impact the M&A market activities. Like the United Nations Sustainable Development Goals have established 17 distinct ESG-related focus areas, along with the 169 associate targets, covering a wide range of climate issues, including affordable and clean energy, climate action, good health, well-being, innovation, infrastructure. I think this subsequently lead to a lot of emerging business opportunities and sectors. For example, major energy company where we like to expand the business into the renewable business like BP, Royal Dutch Shell, and also a lot of financial sectors all would like to expand their service platform in analytical capability like Moody, KKR, even our firm want to acquire something with expand ESG expertise and the relevant analytical skill. So after we talked about the risk and opportunity, let us see how does it affect in the whole M&A life cycle for ESG components. So in fact, it does affect for the whole life cycle from target selections, that means deal originating, to post-merger integrations. So you might ask yourself, oh, how does it apply to such wide range of the M&A market? For example, in the target selection stage, the potential acquirer may holistically assess the potential target long-term risk and grow with the ESG considerations. Corporations are increasingly seeking out transactions that will help achieve the ESG targets or reduce the carbon emissions. For example, the acquirer may place a high regard on cultural compatibility, and if a company acquires a target with a construct corporate culture from its own, it might create challenge to integrate human capital and potentially cause a negative impact on the realization value of a deal. So that's why, but that doesn't mean no solutions. So a range of ESG ratings like ISS, MSCI, Sustainalytics have been deployed and consistently reviewed to examine such issues to provide indication to acquirers on the target's ESG performance. So after talking about the target selection stage, we can go to the due diligence stage. Once you identify a target, you might see whether they really have reviewed the ESG performance. So you may, funds or other acquirers may employ experts to do ESG due diligence along with other diligence. So the ESG factors, including data, policy availability, are critical to determine the transparency for the acquirer to assess the target's ESG performance. For example, it is important to disclose carbon reduction mitigation measures and collect relevant data to predict the ESG risks and understand whether the transition fits the overall ESG M&A strategy. We will discuss more in the case study, how the ESG due diligence is conducted in the later case study. So when we talk about once we have due diligence, we found that the target is good to go, apart from the financial performance, ESG performance, then you might think about the valuation stage. The availability of ESG information and data had enabled the acquirer to take relevant consideration and adjust value adopted in the financial model when determining the value. For example, comparatively green building with higher green building certificate rating and may indicate that high energy efficiency or rental achievable. So with high rental yield or lower operation expenditures, we're likely to increase cash flow and result in high valuation outcome than similar properties nearby. So that's why, when we do valuations of, when we pick ESG factors into valuations, we might adjust the discounted rate, the weighted average cost of capital. But of course, it also has some challenge in this area, such as how much, how extensive, you do the adjustment, or maybe there's a risk of double counting of the risks and opportunities. There's all the big factors need to be considered, in the valuations if you want to take ESG into considerations. So finally, there are also, a lot of research showing that ESG integrated into the target and merge business is critical to determining the success and smoothness of the post-merger integration stage. So this can ensure that potential challenges and issues are expected, addressed, and mitigated. For example, a manufacturing company which have all operation policy or manuals in place will provide clear instructions to workers to resolve issues in different situations and to retain production efficiency, whereas that doesn't have. This will safeguard and stabilize business efficiency, lower relevant risks in the long term, and hence sustain the value of the business. So as more successful acquirers have built successful cases in incorporating ESG considerations into their M&A strategies to facilitate the M&A deal and to merger process, we see the merge of ESG assessment, and an M&A life cycle as a continued exercise for corporation to explore and execute. So we have talked about the life cycle. How does ESG apply? Let's explore, the relevant challenge and opportunities in ESG deployments in M&A. So challenge and opportunity do coexist. As like I said, the coin always have two sides. So understanding the key challenges can help to create and facilitate the plan for new opportunities. Here are some challenges that acquirers shall expect to face and get prepared to tackle. So I think you might aware that the regulator of the world had imposed more disclosure requirement, just like Hong Kong Stock Exchange has first announced the requirement of ESG reporting amongst all listed companies in 2015, and now they also require the TCFD compliance disclosure for listed company. So most listed companies were overwhelmed, in disclosing and processing the required information to report the ESG performance. The M&A markets, up to now, still facing a similar challenge. For example, funds, also may be required, to have relevant ESG disclosure. So despite it is easier to get access to ESG information over the years of the tremendous efforts, by the regulators in facilitating data disclosure by multi-authority and regulators, acquirers more always find it hard to quantify and translate into financial risks and metrics. I think this is the major challenge, the acquirers, or most corporate face, is the data availability, the integrity of it, and the interpretation of it. So the multitude of providers and limited, correlations, also make a headache, to the acquirers. So the opportunity here is once an ESG mechanism is developed, data shall be readily available to further analyze and justify the forecast financial performance. So just like that's why a lot of financial sector consultancy firm, like to express their arm to acquire, a more ESG, analytical platforms. So as mentioned above, it is not an easy task to translate ESG information into financial metrics and reflect in forecasts. There's no one size fit all framework to advise such exercise. But because of this, corporations shall put more effort, to identify different business material ESG issues and directing the right resources to optimize the target business operation and formulate the relevant strategies to enhance the long-term value. So identifying and benchmarking the ESG performance may also be challenging. So participating in different assessment platforms, such as GraphSpeed, will help to illustrate your performance amongst the comparables. So advise the competitiveness in terms of ESG and expose the company to new and emerging green investors. So it is a opportunity to attract more investors who might be looking for ESG compliant products. So last but not least, as there are solid countries and government, are looking for, sustainability commitments, they are aware of the greenwashing issue as well. So they might, try to, avoid, such greenwashing, transactions. So company shall walk the talk, take actions, and set targets which will enhance the ESG performance, align goals with potential investors and shareholders, not only to lower the investment and business risk, but also earning meaningful opportunities and outcomes. So when we have talked about, the risks and opportunities, how we tackle it, let's see about one of the important tools is ESG, due diligence, because people might ask a question, how do we identify the risks or the opportunities? So ESG due diligence is a very useful tool, to help to answer these questions. So, and also interpret the risks, and opportunities. So pervading market statistics show that the majority of sustainable funds that focus in ESG factors across both equities and fixed income outperform traditional peer funds and have reduced investment risk. So expanding a business while being mindful of the ESG elements have proven to be feasible and correct. So another reason why there was an emerging trend of ESG due diligence and people try to integrate, ESG, into their M&A life cycle is, for example, according to the EY 2022 CEO Outlook Survey, a tremendous over 99% of the survey CEO take ESG into consideration, seriously taking this into consideration when looking at buying strategies. So that's why we expect more corporations will place great emphasis on ESG when undertaking M&A. So this reflects the rising importance of ESG due diligence in assisting acquirers to determine whether or not to proceed with the M&A. Another reason is that the regulatory bodies and authorities across the globe have increasingly implemented many sustainable investment regulations and ESG-related disclosure requirements in the market. So for instance, China introduced its first ESG disclosure standard on 1st of June 2022. The US SEC proposed enhanced ESG disclosure requirement for investment advisors and companies in May 2022. So ESG, that's why the regulations still keep on evolving. So ESG due diligence will only get more important in M&A deals in the sense that it prevents a company from acquiring a target that might be at risk of non-compliance of ESG regulations in its respective jurisdictions. It's getting more important as well because a lot of funders, like our clients, keep on asking me, "Oh, Sammy, do you have any ESG compliance product? How can we make our firm more ESG compliance? We're looking for this kind of thing." So you can tell, why it's having increasing trend in this. Another reasons that we witness is that ESG related M&A values have skyrocketed in recent years from 92 billion in 2020 to 103 billion solely in the first half of 2021. So this indicates a large numbers and size for ESG related M&A deals are coming forth. So subsequently, the ESG performance of the targets has to be escalated to grasp the inevitable trend and ensure that they are competent in the market for M&A deals to happen. So ESG could cause an impact on the deal value as well. For example, we have done, ESG due diligence. If they're poor ESG performance, it might affect the selling price. So despite the target may have good financial performance in the past, so ESG due diligence provide companies with a more comprehensive analysis of risk and enables a longer forecast of the company's performance. So we have talked about, why, ESG is coming forward. ESG due diligence is more important in the M&A market. Let's talk about the value side. So implementing, the ESG due diligence for M&A will surely uplift the long-term value, and enable a more sustainable outlook on business performance. It has tremendous benefits in different aspects, such as optimizing efficiency, increasing fundraising capability. As I mentioned, a lot of funders, asset owners are looking for ESG complement products, meeting compliance and enhancing the overall profitability of the target markets. There are also, we need to identify ways for buyer to create value through government grants, tax breaks, or increase ESG score. So ESG due diligence will require quality assurance, operation and contingency operation manuals policy. This could guide employees to ensure business operates as usual despite any situations. The fact that business governed and managed under a proper ESG framework will help to open up opportunity to assess ESG of green investors who prioritize ESG when making business decisions in providing funds. So in the past, we have witnessed the stringent on the ESG disclosure or environmental regulations, such as the ESG exercising progressively expand the scope of ESG, the ESG disclosure. There are countries have started making it a law to charge tax and or carbon tariffs and penalize companies who did not comply with such requirements. So in some extreme cases, the state of local government could cease the operation until certain requirements are fulfilled again. So you can see that, you know, ESG due diligence is apart from assessing risks, it also helps to identify opportunities, you know, to obtain long-term sustainable value. So after talking about, you know, the key ESG due diligence, let's talk about, you know, what other consideration factors you need to do before the ESG due diligence. So the scope of ESG due diligence is tied to materiality of the different ESG factors, the target and the acquirer. So for example, you know, but you can tell ESG is a very wide topic, you know, how can we know that what is relevant? So that's why a maturity assessment is a key for that. So while there are a number of factors that can be considered for formulating the scope, so when we do the scoping, several considerations are certainly critical to consider prior to conducting ESG due diligence. So the identification of material ESG factors is vital in determining the scope of ESG due diligence. It draws the boundaries to the target company on what has to be examined in the due diligence procedures, such as the regional, industrial, and sector-specific factors. The use of materiality map will also supplement further insight on the external factors that may affect the decision of material ESG issues of the targets and the acquirer. So besides, acquirer and targets need to consider the corporate value incurred throughout the ESG due diligence process, as well as the anticipated value generated after the deal happened. So risks and opportunities related to the regulatory and the reputation aspect of the M&A deal and the operations of the corporate after the deal may potentially have serious impact on corporate value and social responsibility. So for example, like Shell, acquisition of a leading renewable power platform in India, namely Fudan Energy Group, had definitely helped Shell to transition itself to a greener business, generating greener energy, you know, than the traditional oil. So as Fudan Energy is doing solar and wind power. So understanding the business cycle, such as the value chain, operation, and carbon footprint are critical to identify material ESG risks. Topics such as circular economy, quality assurance, supply chain management are the key topics in this aspect. For instance, let's talk about the relevancy. For example, a manufacturing company may pose concern related to production quality control and health and safety issues, whereas a service provider may emphasize more on the training and development of talents. So last but not least, acquirer should also go back to the investment and business goal to see how ESG fit into the relevant strategy and whether the acquisition will contribute to enhancing the ESG performance, you know, of the existing portfolio and align and achieve the business objective. Once the goal is confirmed, the acquirer may have a clear picture of what sort of ESG factors that be taken into consideration and are key to determine whether it is deal or no deal. So it is quite common to see that, you know, a lot of reputable fund like BlackRock will start to reviewing the portfolio, whether they are ESG aligned, and look at the ESG compliance and disclosure as well. So after talking about the key considerations before the scoping, how to narrow down the material relevant topics, let's talk about the approach, you know, for ESG due diligence. So the comprehensive approach of ESG DD should aim to generate value, provide both buyers and targets with mutual benefits that are well beyond compliant with ESG standards and guidelines. To be honest, I can tell the market right now, especially in Asia or Hong Kong, is more focused on the ESG compliance or tick the box. You know, when the acquirers, you know, investor ask us to do ESG due diligence, they quite frankly told us that, oh, Sammy, so sorry, we just do a tick a box exercise. So that's why we hopefully the trend which will change, and they can see through, you know, the value of doing ESG DDs, not just to identify risk, but also identify opportunities, so to obtain long-term sustainability value. So the ESG due diligence process may kickstart normally by conducting, you know, maturity assessment. So I think this one, I would like to share, you know, a case study. For example, we have helped a fund, you know, who approaches to do a ESG due diligence on its target. The target is a B2B e-commerce platform, you know, doing medical related products. That at the first of all, when we approach a management, you know, to conduct the scoping, to briefing of them, the question they ask the management, the first question they ask us is, oh, Sammy, we are e-platform. Why is it ESG relevant to us, you know? So, and then we explain to them, you know, at first they're quite receptive, you know, reluctant, you know, to cooperate and understand the rationale behind. And then we talk to them, hey, you know, you still have energy consumption, you still have supply chain management, customer is a whole, you know, a whole cycle, you know, of your business cycle. Might be ESG factors may be relevant. So at the end of the day, oh, and then we do the recommendations and actions at the last, you know, the briefing sessions. Then they did tell us, oh, it is quite useful, you know, because we have made certain suggestions like automation of certain things to reduce the overtime of laborers, you know, and also some policies they can impose, you know, to improve the performance. They are quite, you know, welcome such. Maybe let's go through, you know, how do we do the case study. For example, we will first to do a maturity assessment. As I mentioned, ESG factors is widespread. So how does it, or what ESG factor might be relevant to that particular target? So we might need to apply certain, you know, recognized framework like GLI, SASB, you know, or others, you know, to set a framework, you know, to identify the material ESG topics for them, you know, and then, but we also need to consider a lot of, you know, industrial specific approach, you know, to select the applicable ESG topics. We also need to think about the organization context, you know, that is applicable to reflect the ESG issues to the company's operations, geographic jurisdictions, product and service value chain, and customer interest and concern. So for this client, the B2B e-commerce, we have, because it's an e-commerce, we identify certain relevant, you know, material topics such as data privacy, or cybersecurity, you know, and the supply chain management, etc. for this business. So after we have identified the topics, we need to do a maturity analysis. So that means we need to set criteria for each material ESG topics by identifying the material assessment to evaluate the performance of the target. So a lot of criteria such as the carbon footprints, you know, and the environmental, you know, risk exposure, you know, workforce diversity engagement, all has been employed, you know, to identify the matrix. So each of these categories can be further, you know, segmented into evaluation criteria based on different inputs based on international recognized framework. So after that, by this process, we have used different tools or methods like questionnaires, interviews, stakeholder management, you know, the C-suite, you know, engagement, etc. You know, to align, you know, the acquire, you know, and to align the acquire and the targets, you know, strategies and culture. So and then we also need to conduct, you know, some documentation and literature reviews and interviews to use to evaluate how each of the ESG topics, you know, is addressed. So that's why at the end of the days, we have provide findings and recommendations to them. So that's why it can also use it as a KPI, you know, for the acquired to continue monitoring the ESG performance after they do the post-merger integration. So from this case study, you know, what is the value that you can see through is that there may be some help to negotiate the price, you know, deals, and also some terms, you know, for example, whether any ESG performance clause, you know, should be included in S&P. So hopefully, you know, this will create value, you know, for the acquirer to identify the opportunities and capture the opportunities to obtain, you know, long-term value, you know, of the acquisition. So after sharing, you briefly talk about the case of the, you know, some experience for the B2B, you know, e-commerce platform, you know, it's a simple one. So we did it in a very accelerated time frame in 2 weeks time. So, but I can tell you that if you ask me for doing ESG due diligence, please give us more time. But we only do it in a very accelerated time frame. It's not the normal time frame to do that. So finally, I know it's running out of time. So I briefly talked about, you know, the future trend. You know, there's the future trend for ESG and M&A interact with each other. You know, it comes to it affects a lot of areas like the selection of targets and business partner. So it is likely that the more acquisitions, you know, will be occur, you know, when will be considered, you know, whether the ESG performance is one of the considerations when you select the targets, whether the target is ESG compliance is also one of the considerations for the investor to think about. And looking for business partner who did have the ESG mindset is also another emerging trend. And so also the integrations and governance of we have discussed. So in the M&A context, the ESG board committee, you know, will be formulated. You can see more roles such as the chief sustainability officer has emerged, you know, to overlook and review the implement the ESG rated policy and initiative to ensure sound governance. So apart from that, as I mentioned, due diligence already, so I don't talk in too much about it. You can see the trend of ESG due diligence will be apart from financial due diligence, IT, legal, DD, tax duty. So ESG duty maybe become one of the important elements as comparable as those other due diligence that have traditionally happened in M&A transactions. So, and then you will see more stakeholder involvement is increasingly important when scrutinizing a company's ESG performance. Stakeholders like investors will seek ESG KPI and data as per materiality assessment to understand how well the target respond and to mitigate relevant risks. So going forward, companies may need to consider how to address the concern of the stakeholders via different engagement initiatives and channels such as transaction rollout, investor presentation, press release, and subsequently how ESG concerns are addressed and mitigated in the M&A transaction as well. So finally, financing. So I won't talk too much on this because I know another expert, you know, in this will talk about the financing. But maybe I'll briefly talk about that the lenders expect to see the potential impact of significant ESG risk on the creditworthiness of business and industry. And over time, company may find, you know, correlations between the access to capital and the ESG performance. You know, having ESG performance data in place will also help to fulfill the lender's assessment criteria and enable room for an explanation for improvement plans when necessary. So in the market, we have observed that certain banks will only grant the loan when the project is qualified as green or able to undergo certain related assessment. So some banks may offer lower interest rate if the project is eligible to fulfill their green standards due to a lower risk assess and enable a longer forecast on financial performance and also fulfill the bank's sustainability approach, plan, and strategy. So again, the inclusion of ESG consideration may enable the deal to benefit from initiatives such as green financing and loan and bond products like green loans and sustainability linked loans. I'm not talk too much on this financing because I know the expert is going to talk about it later. So in light of time, in conclusion, for the ESG due diligence, I think it's a very useful tool to avoid, acquiring greenwashing projects, and also we become, essential elements, in a M&A transactions, like those traditional FDD, tax DD, ITDD, and hopefully and also see that, it will emerge from a tick the box exercise, to more value creations exercise. So full impact of ESG on M&A has yet to fully seen, particularly with the evolving regulations and different perspectives and priorities of the investors and stakeholders. But let's see, what will happen, for the integration of ESG factors in the M&A market. So thanks for listening to me. That's for today's my presentation. Thanks so much.
Thanks very much, Sammy, for sharing your good presentation. We'll hear more from you during our panel discussion. So as you already alluded to, we'll move now to Andrew. Hey, Andrew, good to see you.
Hello.
Please lead us into the wonderful world of sustainable finance, and I look forward to our panel. So over to you, Andrew.
Thank you. Just want to make sure you can see my screen. Yes?
Yes, very clear. Thank you.
Thank you. Good morning, everyone. It's a real privilege to be invited onto this panel to share on ING's sustainability strategy. So as touched on by Lapman's introduction, I'm part of the sustainable finance team in ING Bank. And so ING is a global financial services company engaged in both retail banking and wholesale banking. So we're headquartered in the Netherlands, of course, but we have presence in some 40 countries across Asia Pacific, Europe, and the Americas. So I'm based in Singapore, but we have colleagues in Hong Kong as well. We have over 57,000 employees supporting corporates with financing, advisory, and financial markets hedging solutions. So today I'm going to talk about how banks, through sustainable finance instruments, and it was sort of alluded to in the later part of Sammy's presentation, so how banks, through sustainable finance instruments, do their part to fight climate change, and the implications for many of you on this in the audience today, the implications for borrowers. And so in ING, there are three sustainability related teams. We have firstly our ENS, risk management team, so environmental and social risk. And they approach ESG with a pair of defensive lenses, because we finance many projects and many companies around the world. So they are there to evaluate if these projects are a threat to biodiversity in the very locations they are situated in. Do the companies that we're financing engage in ethical labor practices, so on and so forth. So all these considerations to weigh before approving a loan. And then secondly, we have our group sustainability team, which measures, tracks, and manages our bank's scope 1, 2, and 3 emissions. And they're also the team responsible for managing external stakeholders like our shareholders and the various regulators in the many markets that we conduct business in. So that's the second team. And then the third team, where I'm in. And so this is the third vertical alongside the group sustainability and the ENS risk management, and that's the sustainable finance team. So you look at the name sustainable finance, it's really a combination of two topics, sustainability and finance. And so that means we incorporate sustainability targets into the financial instruments that we extend to clients, or you can look at it from a mirror image standpoint, where we're leveraging on finance to enable and incentivize our clients to make positive environmental and social impact. So that's more on a philosophical level. On a more practical level, that means we help structure sustainable finance instruments like the one Sammy talked about, green loans, sustainability linked loans and bonds, social bonds, and so on. And so whenever I get asked on ING's approach to sustainability, or when my clients ask me on how they should incorporate sustainability into what they do, and perhaps some of you in the audience have this question in your mind as well, my answer is invariably the same, that you can take a leaf out of ING's book That means you can take reference to what ING is doing and replicate and apply to what you can do in your firm. So I'd like to illustrate in very simple terms and allow you to visualize accordingly. So we as a bank, we're intermediary in the financial services ecosystem. As a bank, we take in deposits from our retail customers. We issue bonds in the wholesale capital markets. And so we take in money from bond investors. And so we deploy all these capital from the liability side of our balance sheet into the asset side of our balance sheet, into loans for our customers, both retail, but also corporate and institutional. So it's very similar to some of the asset managers, some of you are in the audience today, who take in third-party money from asset owners, so the institutional investors, the pension funds, the endowment funds, and then deploy them into financial assets and real assets. It's also very similar to the corporates out there. Many of you are in the audience. You are also an intermediary in the sense that you deal with suppliers on one end. Suppliers will supply you with raw materials. On the other hand, on the other side, you have your customers who buy your finished goods and services. So we're all intermediaries at the end of the day. As intermediaries in the economy, we have some degree of leverage and influence over our borrower customers, in your case, over your suppliers. It is through the deployment of our balance sheet, and for you corporates, the deployment of your procurement and the purchasing that you exercise this influence. So for us as a bank, when we deploy our balance sheet towards client activities, we make choices. We make choices about how, where, and with whom we do business. So we obviously consider commercial and financial metrics when deciding where to deploy our assets into. But increasingly, banks are using this position of leverage and influence to get those companies that we finance to make a positive impact in fighting climate change and making positive contributions to society. And so in ING, we exercise this position of influence in broadly 3 different ways. So while these 3 different ways are sort of specific to us as a bank, I think they'll be highly instructive to you in the audience, those who are corporates and asset managers. And so the first approach to take is by saying yes to transactions and borrower customers. So obviously we say yes to renewables. Over the last 5 years, ING's exposure in renewables has more than doubled and now makes up 60% of our power generation portfolio. There's more we can do. And that's why we recently set up a goal to increase the yearly amount that we commit to renewables to be 50% more in 2025 compared to 2021. We're also looking to increase the number of sustainable finance transactions closed on a year-on-year basis. So in the year 2020, we closed 139 sustainable finance transactions. We more than doubled that. So from 139 to 317 in the year 2021. 317, I mean, think about it. 317 transactions in 2021. That is more than 1 such transaction every working day of the year. And so that's number 1, by saying yes to certain customers and transactions. Now, our second approach is to say no. We say no to companies engaged in unethical labor practices, those that are compromising worker health and safety, companies that are engaged in deforestation, the harming of marine life, so on and so forth. We were amongst the earliest banks all the way back in 2015 to have turned off the financing tap to coal-fired power plants. And in less than 3 years' time, by 2025, we would have reduced our balance sheet exposure to coal to near zero. And so the first approach is to say yes. Second approach is to say no. And the third approach is to say yes, but. So many a times we put ESG conditions or ESG KPIs to financing a client. We've made ESG improvements as both a carrot and a stick for some of our borrowers. A carrot like decreasing the interest margin slightly if our borrower makes improvements in their GHG emissions, in their use of renewables as a source of energy and so on. And a stick like the interest margin increasing slightly should the ESG improvements not materialize. or not doing business altogether if there's been significant deterioration. So the sustainability linked loan that we did with Royal Philips in 2017 is a prime example. It was the world's first sustainability linked loan. And today, this market, this sustainability linked financing market, made out of both loans and bonds, is in the hundreds of billions in annual issuance per year. For ING, we're very pleased to have been the pioneers of this product back in 2017 to help catalyze this entire market. So out of the three approaches, I would just like to make a special mention about the last approach. We think it is far more effective in the global fight against climate change to support our clients to improve, rather than exclude them altogether. Because excluding them means that you're passing on this responsibility of this position of leverage and influence that I talked about into the hands of another stakeholder. So we in ING realized very early on that in order for all of us to have a chance to reach this 1.5 degrees Celsius goal, we cannot just bank the best in class. We cannot just exclude the highest emitting companies, i.e. the two ends of the spectrum. We need to engage this big sandwich in the middle to improve together. So everybody needs to improve together, and hence our yes, but approach. Now, essentially, we're saying to our borrower customers, today you might be in this position in your sustainability journey. We want to incentivize you to move in the positive direction in this journey. And if you do so, we'll reward you with lower interest rates. So for those in the audience today, if you represent corporates, in the same way, recognize the position of leverage and influence you have on your suppliers. In fact, not just recognize, but embrace this position. Utilize the yes, but approach. Leverage on this position of being your supplier's customer to shape their ESG footprint, both directly through purchase decisions or RFP selection criteria, and also indirectly through product design, rather than just a procurement process that is based solely on price and quality and delivery timeline. Start incorporating sustainability into your screening criteria. Make it a hard requirement that all prospective suppliers provide documentation of their ESG practices in the RFP responses. Put some weightage of your purchasing decision based on the carbon intensity of the raw materials that they are selling to you, because this carbon intensity will affect your own company's Scope 3 emissions. Don't be shy to ask your companies to provide detailed information on their own carbon footprint. In short, don't pass up this opportunity to use this position of leverage and influence on your suppliers. And for the asset managers in the audience, you're similar like us, a bank. The biggest impact that we can make on the global fight against climate change is through our financing. As a bank, we don't have that much of a primary carbon footprint. Sure, we can procure more electricity from renewable resources. We can reduce our energy usage in the office, our water usage. But even if all that were to magically go to zero, our energy usage were to magically go to zero tomorrow, it will not move the needle that much. But if we align our 600 billion euros of loan portfolio to a 1.5 degree scenario, and that means all the activities, all the business activities and projects that is enabled by our 600 billion euros of financing become aligned to a 1.5 degree scenario, then I think that's a real dent in the fight against climate change. And so for the asset managers out there in the audience, the biggest impact that you can make is through your investments. You are not industrial companies, so you do not have an extensive carbon footprint and water footprint to begin with. The biggest impact that you can make is through your investments. Use this position of leverage and influence on your investees' companies to shape their ESG footprint. Don't just rely exclusively on risk and reward, but start incorporating environmental and social impact into the equation as well. So use the yes, but approach on your investee companies to prod them into positive change. And so these approaches are the ones that we take as a bank, but I think they're equally replicable for you as an asset manager or as a corporate. And in the second part of my presentation, I will delve deeper into how we're steering that hundreds of billions of euros in our loan book towards business activities that collectively align with the Paris climate goals. So we call this our Terra approach, and it's what I mentioned before, that we as a bank, sure, we have a primary carbon footprint in terms of the electricity that we use in the office, for example, but our secondary footprint far exceeds our primary footprint. And this secondary footprint is about the business activities and clients that we enable. Now, with this 600 billion plus euros loan portfolio, how do we ensure that our carbon footprint in these companies and projects that we finance meet the climate goals? Now, we're not a climate research firm, we're not a climate scientist, we're a bank. So we know the role that we have to fight against climate change, but we depend on what the climate scientists tell us. They tell us that we need to get this certain carbon emission intensity in the various sectors, whether it's in power generation or cement or automotive or steel and so on. And we compare that carbon intensity of our loan book with what climate science tells us we need to get to by 2050. And so our job is, as a bank, is to measure that carbon emissions and intensity, and then steer those emissions intensity down accordingly. So I think it will be much clearer with an example. So let's take the automotive loan book as an example. So the chart here shows how we look to align our automotive loan book to business activities that will be a 1.5 degree scenario. So let me reconstruct this chart using the next series of subcharts. So essentially, we start with the blue colored dot at the bottom right-hand side of the page. This is where the automotive sector needs to get to by 2050, which is, if you look at the y-axis, is about 50 grams of CO2 per kilometer travel. And that is what climate science tells us we need to get to. We as a bank, then we start measuring and tracking the carbon emissions in our automotive loan book. And that is a function of the clients and the business activities that we finance. So you can see that in the year 2018, when we first started measuring, our automotive loan book was at about, I think, 230 grams, give or take, CO2 per kilometer travel. And so we then draw a curve joining where our automotive loan book was in 2018 to where climate science tells us we need to get to by 2050. And that is that convergence pathway, or the decarbonization pathway that we need to take in the years and decades ahead. So numbers wise, if you look at the y-axis, that means our automotive loan book needs to decrease from 230 grams of CO2 per kilometer travel to 50 grams. We then track how we perform on a yearly basis against this target. So for example, you see in 2019, we were slightly above the blue curve, which is our target. And then in 2020, we did a little bit better. We slightly outperformed our target by coming in below the curve. So that is on a theoretical level. But on a practical level, what are the ways we can influence the CO2 intensity of our automotive clients? So how do we decrease from 230 to 50 grams? Firstly, by ensuring that our loan origination focuses more on low carbon activities and away from high carbon ones. And number two, by supporting and engaging with our existing clients to start shifting their investments away from high carbon activities into low carbon ones. So for number two, we engage for the second point that I talked about, engaging our clients. We engage in open conversations about sustainability and their own transition pathways. We try to be very transparent with them and have an honest discussion with them using these pathways that I'm showing you as an illustration. So for example, imagine you are your CEO or a CFO of an automotive company. Imagine you're a company that is way above the curve, very much above the curve that we're aiming to get to. do you think you'll be an attractive borrower to a bank like ING or any other banks? Because a lot of banks out there are also adopting the same approach. On the other hand, if you move from above the curve to below the curve in terms of carbon intensity, think of the much larger lending interest you would attract and potentially even more competitive interest rate as well. Another sector, I know it's a sector that's very close at heart to Hong Kong, is the commercial real estate sector. And looking at the attendees of this panel discussion, I do see quite a few representatives from this sector as well. So I think this will be extremely instructive to you. Through this example, you understand how banks are starting to view you, not just in the traditional metrics of credit risk and the pricing of the loan, but also the carbon intensity of your real estate portfolio. So the same way as I did for our automotive loan book, let me reconstruct this chart from scratch. So if I can bring your attention to the two dots at the bottom right-hand corner, you can see the target that has been set by the Dutch Green Building Council in their Paris-proof Delta plan. And that is represented by the light blue dot. And our own ambition represented by the light orange dot. So these are dots on the horizon. These are long-term targets that we look to achieve to ensure that our commercial real estate loan book is in line with the 1.5 degrees climate goal. And that goal, if you look at the y-axis, is to emit 0 CO2 per square meter of gross floor area. So once we've set our targets, the second logical step is to look at where we are currently. And this is represented by the orange dots at the top left-hand corner. So in 2018, in terms of the y-axis, we were slightly above 50 kilograms of CO2 per square meter. And then we improved slightly to slightly under 50 kilograms in 2019 and further improved that in 2020. So the idea is that the carbon intensity of our CRE loan book should go progressively lower and lower on this decarbonization pathway towards our 2040 ambition. And so this decarbonization pathway connects where we were and where we are towards the climate ambition and where climate science tells us we need to get to by 2040 and 2050. And these two lines represent our annual targets in the years and decades ahead. So I should make a note that the scope for this measurement and monitoring currently only covers our lending to mid-corporate real estate clients in the Netherlands, but we're working to expand the data coverage to add other countries in Europe and other parts of the world where we have a significant commercial real estate exposure, and including Asia Pacific. Now, that's on the theoretical level. Now, on a practical level, what are some of the levers that we can pull in order to ensure that we are on this decarbonization pathway? Number one is to enable more energy label A property construction by providing the financing to get them off the ground. So that's number one. Number two, it's providing financing for our clients to embark on CAPEX to improve the energy efficiency of their real estate holdings. So that's the second way. The third way that we're helping our clients is to supply them with this online data analytics tool that weighs the CAPEX investment that they are planning to take against the OPEX savings and the CO2 reduction of that CAPEX investment. So empowering them to take decarbonization decisions. And so if you're sitting in the audience today and you are an owner and operator of commercial real estate, you're probably very familiar with the traditional financial and credit metrics that banks evaluate you as a borrower. Things like WALE, weighted average lease expiry, occupancy rate, interest coverage ratio, DSTR, LTV, and so on. Now, increasingly, I'm here to tell you that your carbon intensity is and will be increasingly a new metric that your banks will look at because of what I explained earlier. Banks are tracking the carbon intensity of the properties that they are financing. And so we do this for our automotive loan book, as I explained. We do this for our commercial real estate loan book. And we do this for the loan books of the other sectors that we are actively involved in. And this is represented by this very busy slide here. So ultimately, it's the companies in the real economy that bring about change. Banks such as ING, we finance change. Our depositors entrust us with hundreds of billions of euros. We are stewards of these hundreds of billions of euros. And the responsibility and the responsible thing to do is to steer these 100 billions towards climate goals to ensure that we reach a 1.5 degree scenario. For the asset managers in the room, I say to you, use your unique position of leverage and influence over your investee companies to engage them in a conversation about transition and sustainability. Engage them in a yes, but dialogue. You are similarly stewards of hundreds of billions, maybe even trillions of dollars. So while we as a bank, we finance change, asset managers like you in the audience, you invest in change. For the corporates in the room, I say to you, yes, you all have a responsibility to reduce your own GHG emissions. It's, however, critical to recognize and embrace that your actions affect your stakeholders' behavior as well. One such stakeholder is suppliers. So use that position of leverage and influence over them to engage them in a conversation about transition and sustainability. Steer their ESG behavior through the yes but approach. And lastly, for all those in the room who obtain your financing from banks, I hope that through the second part of my presentation, it has become very clear to you that banks are no longer just relying exclusively on risk and reward in their financing decisions, but environmental and social impact have started to come in as a third factor as well. With that, I conclude my presentation. Thank you very much, Lapman, for this opportunity to present.
Thanks a lot, Andrew, for and I think it was a very clear call for action that you provided, and it's good to know that ING is actually financing change in the world, and good for us to have a look into the kitchen of ING and your own mind as well to create a better world. So maybe with that, let's start the panel for the next half an hour or so. Maybe we'll stick with you, Andrew, for the broader view in Asia around the sustainable finance market, because I understand, I think 2021 was probably a good year in terms of the issuance of sustainable finance. I think people have heard about green bonds, social bonds, sustainability bonds. You talked about sustainability-linked loans. I know that there is a particular classification, distinguishment, use of proceeds. Can you share a little bit around what you're seeing are some trends and developments here in Asia? What products, sustainable finance products, are really in demand by corporates that want to make a change? And how can you give some examples of that in Asia? What are the key products? What maybe some real life examples of challenges or opportunities that you think would be good to hear that, Andrew?
Sure. I think to see where we're going and where we're at is useful to sort of take a step back and see where we've come from. I think we look at the birth of the green bond really started in 2007, 2008, I think. So I think there was a group of Swedish pension funds that sought to invest in projects that help the climate, and that prompted the World Bank to issue a green bond. So raising funds from fixed income investors to support lending for eligible climate-focused projects. But the gap in the market as a result of these user proceeds, and we call green bonds and social bonds as user proceeds instruments, is that they sort of only are suitable for the best in class. So if you're a renewables developer, sure, you can issue a green bond, no problem. But the bulk of the economy aren't real estate aren't renewables developers. So there's a big sandwich in the middle that I talked about, and if we were to all collectively reach the climate goals, then everybody, I underscore that, needs to improve. And that's when ING pioneered the sustainability linked financing product back in 2017. And incidentally, today, this year, we celebrate the 5th anniversary of this product that has really taken the market by storm. And so that took the focus away from the use of proceeds. So if you're raising a 500 million bond, that took the focus away from that proceeds going into green projects, but started to look at the company in terms of their ESG KPIs and their associated targets. So if you take up a sustainability linked bond or issue if you take up a sustainability linked loan or issue a sustainability linked bond, then you can use the proceeds for general corporate purposes, but you then have to set up some material ESG KPIs for the company. So we saw that in 2017, even very much so today. And we saw this sustainability linked financing products spreading across from the financing arena into the financial markets arena as well. So in August 2019, there was the first sustainability linked derivative that was done in the market. It was done with ING's client, SBM Offshore. So it was an interest rate swap where the discount on the fixed rate leg of the swap will be applied if the target ESG score for SBM was met. So that was spreading into the financial markets. And also in October 2019, we did the world's first sustainability-linked capital call for a PE fund named Quadria Capital. So, and this was big because traditionally the sustainability-linked loan product has been in the domains of corporates. And so we sort of ported that over into the private capital PE space with the rationale that shareholders, and that's what PE firms essentially are, they have a great deal of influence and leverage over their portfolio companies. So it was to help them to influence their portfolio companies to become more sustainable. So we see a lot of products in the market, and it's just spreading across the financial arena right now. And just one more example to bring out, in 2021, there was also the world's first securitization with a sustainability tranche. And that was done for the Singapore government sponsored Bayfront Infrastructure Management. And their business model is about purchasing project finance and infrastructure loans from commercial banks, pulling them together and then repackaging them and issuing various tranches of notes of varying returns and risks. And so infrastructure loans in, infrastructure ABS out. Now, some of those infrastructure loans were those belonging to renewable power projects like solar, wind, and hydropower projects. Also, some of the projects were addressing affordable basic infrastructure like electricity transmission and distribution, toll roads, water projects. And that's when we suggested to them, hey, how about making one of your issued tranches of notes sustainable? And it was a meeting of minds. It resonated with what Bayfront wanted to achieve in sustainability. And so it wasn't a difficult sell at all, but it epitomizes that sustainable vision, as we talk about, sustainable vision, which is a buzzword, where it's combining the introduction of innovation into sustainability. So there's a lot of innovation that's happening, but ultimately we're not innovating for the sake of innovating. Ultimately, it's about making positive environmental and social impact. And that's the key litmus test and the high standards that we hold ourselves to. We're trying to make sustainability applicable to every part of the banking system. And that means across as many financial products and services as we can.
No, thanks, Andrew, for sharing that. That's really music to my ears to hear all these different products. I mean, I also come from a maybe 20 years ago structured finance background. Good to hear about the securitization, sustainable linked finance, and ING's role in there. Maybe let's move to Sammy as well. I mean, 2021 was a pretty good year, I think, for M&A, partly driven by ESG. But given that we're here in this part of Asia, do you see any difference in terms of how ESG due diligence is being performed? What are some nuances? Mainland China, Southeast Asia, rest of Asia. Is there anything that you would give as a pointer to corporates and other firms? Any things from all your work that you're doing in the M&A space, Sammy?
Thank you. I would say that, you know, the framework, you know, mostly for ESG due diligence we adopt is for international standards, you know, like SASB or GRI, etc. So the framework, you know, we're more or less the same across Hong Kong, China, you know, and Asia. But I would say that when we do the deep dive ESG due diligence, I mentioned that we might do maturity assessment. During that, we will identify particular, you know, material ESG topics relevant to that target. So I think during that process, you know, anything will be tailor-made, you know, to the local jurisdictions, you know. So for example, when we do the as I mentioned, the case study for EY-Partenon, so we have maybe identified, you know, some cybersecurity, you know, issues. They may be lack of the relevant license in PLC regulations. So that's why maybe one of the remedial actions is to comply, you know, to get the license for the local, you know, regulation. So I would say that overall, the framework mostly will be around the world we adopt, you know, the international standards. But when we go deep dive for each corporates, you know, their relevant assessment, gap analysis, you know, will be also take into account the local, you know, factors. So local policies, and also each country may have different, you know, emphasize, you know, on the, you know, policy area. So we will also need to take account when we do the ESG diligence. So I guess yes or no to your answer.
Okay, got it.
Yeah.
Thanks for that. I think, Andrew, going back to you, I mean, you talked about sustainable linked loans and ING being a pioneer in that. If I look at some research, I see Singapore is pretty active in that space. And I think it's probably Singapore, if I'm correct, it's pretty similar in terms of issuance last year compared to mainland China, Hong Kong, Taiwan. Is there a reason? How do you see, why are certain markets more active? Is there a reason, and where do you see coming activities in sustainable linked loans? And any view on that, Andrew? You probably have.
Yeah, I think it's different financial centers sort of competing to be in this space because they know that this is a space that's going to dominate the banking industry. Well, in fact, the entire economy really. In the years and decades to come, and it pays to start putting the work early and get ahead of the rest. So for the companies in this room, it is the same thing. There's no escaping it. This trend in the years and decades ahead, and the earlier that you get started, the more you build up a lead over your competitors in the market. So that's sort of what I guess the reason why sort of you observe that maybe Singapore is ahead or some other countries are ahead, I think is that recognition that this is a trend that's here to stay. It's not a fad that is just popular for a few years and disappears. It is here for good.
Okay. And I think you, in our preparation, you mentioned these hard to abate sectors like aviation, shipping, steel, as opposed to these renewables project developers. What are some of the products that you maybe already alluded to it are more in demand by these type of industries that are going through that ESG transition journey from a bank's perspective, obviously?
Yeah, so the sustainability linked loan is definitely that, and comes from that recognition that as a company, regardless of whether I'm best in class or not best in class, I need to progress in my sustainability journey, or I can progress in my sustainability journey. So that underlying realization gives them the impetus to start taking these sustainability linked instruments. So and also because the use of proceeds instruments, so like green loans and green bonds, are still quite exclusive. So unless you have a dedicated use of the proceeds, be it to invest in a renewables power generation plant, or invest in a green building, or invest in clean transportation. So those are very restrictive. And so we see the sustainability linked instrument really take off because it is not as restrictive, but it requires the company to set up ESG KPIs at the company level, which over the last few years, we've seen many companies already embracing that. So in a very commensurate way, we have seen sustainability linked instruments being increasingly taken up. Now, I'll make a note about transition bonds and transition loans. So we've sort of seen that come up a few years ago, but we haven't really seen that overlap between sustainability linked instruments and transition instruments, and frankly, competition between the two. So you have sustainability linked instruments sort of taking off because there is a renewed focus on setting science-based targets for them. And as a result, transition bond issuance is sort of suffered as a result. Now, also some of the transition bonds issuance out there have seen quite a mediocre success rate, I would say, with a lot of market scrutiny. So I think it will take a brave soul to try this route again. So my own personal view is that we'll see sustainability linked financing continue to explode, with transition bonds still staying anemic.
Got it. That's very helpful insight. I mean, Sammy, staying with the sector discussion, where do you see more traction or progress in sectors in terms of M&A, where there is either a component where M&A is driven by companies' desire to build sustainable capabilities, or vice versa, or become greener? Are there any particular sectors you would highlight where you see interesting developments for this audience from your work in M&A, Sammy?
Okay. Yeah, I would say that, the renewable energy sector, definitely, clean energy,
right,
to comply with the SDGs are always, the hottest topic, for the M&A market. So in fact, I won't say that particular sector will be more M&A transaction. Indeed, I will foresee that, every sectors, are trying to look into that. For example, like Shell or BP, they look for the renewable energy instead of traditional, fossil fuel. And I also see the, real estate, industry, or sectors is also, have a lot of green buildings, and they, because demand, a large carbon emissions. So they look for the materials, look for any logistic, how to make, more green for the buildings to attract, more tenants, higher yield, etc. So in fact, I see all kind of sectors. For example, I also see automobile will try to acquire, more EV, or EV battery, as a synergy for the existing business. And logistic, company, may also acquire some automate technology, to make it in more ESG compliant. So I would say that, in fact, for the M&A market, I will see that, traditionally for the investor, they may look for, targets, that have very high, high yield, high RR, high return, high financial performance. But I can see that apart from financial performance, they also look at, any synergy or any integrations for ESG integrate into the strategy, or any acquisition targets that can reduce the overall, carbon footprint or carbon emissions. So to reach the targets and matrix. So I will see that, renewable energy or anything that is fit into the overall, ESG will be hottest. But I can also see, all aspect, of M&A transactions, the acquired try to, look for targets that can reduce the emissions, or they can, increase the long-term value, and also synergy, for the traditional business. So I can see this is my overview, on the right. M&A decisions. Yeah.
That's definitely interesting. I mean, Andrew, coming back to you, I mean, I can imagine your relationship managers yourself go out in the market, talk with corporates, they have product, but then at some point you will be in front of the credit committee and they're asking you, for example, of course, I understand if it's a top-notch company, very green, everything okay, best in class, that's fine. But sometimes companies may not be in that place, and you then need to explain how to help them on this transition journey. For example, it might be a company that, I know you can't mention specific names, but it might be a company that is probably doing less than a top-notch Unilever or other company on the green side. But from a US SDG side, they might, for example, still look at feeding the hungry, etc. How do you manage that friction, so to say, in terms of making a change, but convincing your credit committee in Amsterdam to go with the loan? Do they put in more conditions? Is it, can I get a bit of feel how you go about managing or convincing your Amsterdam credit team or Singapore credit team first?
Yeah, sometimes it's both. to convince both teams. But I mean, we won't go into specific names as you mentioned, but I think I can categorically say that we've declined to participate in transactions or lead transactions as the sustainability coordinator, because we sometimes felt that the ESG KPIs were not material enough, or the SPT, the sustainability performance targets, were not ambitious enough, or maybe the structure is not credible. For example, if it's skewed too much in favor of the borrower, or if there are or have been some negative ESG controversies on the part of the borrower or issuer. So, and for a commercial bank, that is a real struggle, because we're interested to do more sustainable finance transaction, obviously, but not at the expense of relaxing the standards or undermining the credibility or integrity of the sustainable finance market. So we will always try to challenge the company to do more. If they're setting this target, can it be a bit more ambitious? Or, do you want to tag yourself to the best in class in your industry sector? And if that ambition is not there, we will walk away. And we have sometimes in the past walked away. The borrower-lender relationship pressures, we feel, should not result in blind acceptance of the KPIs in SPTs. Now, is there some sort of bank shopping on the part of corporates when doing sustainable finance transaction? Yes, there is. But that's why we as a bank, we're actively participating in the industry working groups to try to drag up the minimum standards of the entire market, which should help to mitigate this bank shopping issue. So, and we all in the market, all banks, all borrowers, it is in our interest to safeguard this credibility and integrity of this sustainability linked financial markets or sustainable finance instruments in general, because sustainable finance helps in the steering of capital towards activities that allow for 1.5 degrees Celsius world and a just transition, amongst others. The correct labeling, the accurate labeling of these activities will help to allow the steering of capital. Now, if the labeling system breaks down or is imperfect, or worse still, its whole integrity and credibility is called into question, then capital might then be driven away from sustainable finance. And without adequate financing, then sustainable activities, those that are required for us to reach the climate goals, will be suffocated, and they will lack the capital that it so desperately needs.
You actually already covered the follow-up question, so I will go there. I did want to ask about, so what happens to the corporates that don't get the loan, so they go bank shopping. But it's good to hear that banks like yourself, ING, and others are trying to uplift the minimum standards. And going to Sammy, I mean, some of the audience here are corporates, so they hear all about this, something, how important is ESG due diligence, but how should they prepare themselves, irrespective of whether they are a target or whether they are a potential buyer? What should they look at, or how should they, maybe we'll start with target, should they prepare themselves for any key issues? It's probably industry specific, but any light you can shed on that would be helpful for us, Sammy.
Sure. I think both buy side and sell side also need to prepare for it. let's talk about the sell side first. I think inevitably, given the, regulatory requirement, globally, for the disclosure requirement and the ESG compliance, given the evolving of the regulatory requirement, definitely they should observe and understand, a basic is to ESG comply, for the disclosure for the target. And apart from that, I think they also need to understand the material, ESG factors, that may be relevant to them. So that's why they can try to improve their operation resilience, or to identify risk areas and to also identify opportunities, how to improve their ESG performance. And I think in the long term, they should also, try to set up the relevant governance, to monitor how ESG is integrated into their strategies and their operations in order to obtain the long-term sustainability. So I would say that, from the sales side, from the basic to the compliance of the ESG compliance, the basic, not breach, the disclosure requirement, and avoid, greenwashing as well is the basic.
You're frozen a little bit. Yeah. Something with your. Can you say something?
Washing as.
Yeah, I hear washing. So maybe it's a bit frozen. It's fine. Maybe going back to you, Andrew, until Sammy comes back. So I see that so different banks. So sustainable finance is becoming a bigger portion. Sorry, Sam, bigger portion of your portfolio, Andrew. And when I speak with corporates in Hong Kong and internationally, more and more are using sustainability-linked loans, sustainable bonds. In terms of how do you see the future? What percentage? You don't need to say exact number, but where do you think it's going in terms of a typical conglomerate's balance sheet? Do you see growth in terms of where they get funding coming from sustainable finance, and also from a bank's perspective on the other side of the spectrum? Which portion of banking their assets do you think in the next couple of years be so sustainable? Is it like half of this? Quarter? Are there any goals globally from your discussion with other banks? I know it's a tough one. It's probably heading in the right direction, but yeah. Or while you think about it, Sammy, are you back in terms of voice?
Yes, I'm back. Can you hear me?
Yeah. Okay. Yeah.
Okay. Sorry.
I'll let Andrew guess.
It always happens for the technology.
No worries. Yeah. So sorry. I think I heard the word washing. I think it's greenwashing, not greenwashing. Anyway. So yeah, sorry, please continue before.
Sorry about that.
No worries, technical issues.
The most I scare about, webinars, the technology.
No worries.
Yeah. So I would maybe just recap. I think that from the sales side, the basic is to basic ESG compliance. Understand the requirements, and especially the keep on evolving requirements, avoid greenwashing. And then to identify material relevant topics that to try to capture the opportunities that might arise, and to improve the long-term, value, for in terms of customers, culture, supply chain, all this kind of aspects. So basically, from the basic, to the value creation train is from the sales side, I would say. So because this might help to attract, more better capitals and funding, from the investor who's looking for ESG compliant products. So I think from the buy side, of course, the basic, buy side, when they acquire, would like to acquire some target, the first thing about ESG, they think, okay, what are their ESG rating? Let's look at it, So definitely the ESG rating is one thing they are looking at as something. And then maybe, but ESG rating is only, one of the tools or measures, to understand the background of it. But you might know that, ESG rating, across, different agents may have different score, for the same company. So that's why we only want one of the reference. So I would say apart from ESG rating, they will also need to do a thorough, due diligence, on the target, whether they are actually avoid greenwashing, acquire greenwashing is again avoid acquiring greenwashing target, and also about what their risk, inherent risk, for non-ESG performance, and also the long-term value they might have, and whether there's the fit in their culture and the strategy for ESG strategy in the long term is also quite crucial, because sometimes I think that the acquirer would like to acquire only financial performance before. They don't care about, they polluted the whole, whole area or around it. But nowadays, I think this is no longer the case. Apart from the financial impact, they will also look for your ESG compliance long-term strategies, because they will know that ultimately those factors may erode their reputations or maybe erode the long-term value of it. So just try to avoid the short-term, financial goal, look for the long terms. So they will be all in extreme case, for the acquisitions, they might reflect in the KPI, continual monitoring, evaluations. In the extreme case, they might also change the terms of the imposed covenant in the S&P, for those those transactions to impose KPI or conditions, or even the selling price may be adjusted. So I guess this is something that the buy side and sell side should prepare in the emerge of ESG factors to be and apply across the whole M&A life cycle.
No, thanks. I know we have a separate Q&A session, and everyone in the audience, please do type in your questions. I think there's one that is a bit related to what you said, Sammy, and I saw an earlier question from someone in the audience. They are talking about the use of or reliance on ESG rating agencies, and we all know also we in the academic world, there's a divergence in terms of ESG rating from Sustainalytics, other parties, Moody's VE, etc. There's divergence, of course, we know it's because of the scope, the weighting, the methodology, etc. And how does that glue together with the work that you are doing on the ground, the ESG do? I think that's probably, if I'm looking at the question, so maybe inconsistent. How do you work with ESG rating agency? How do you see ESG rating agencies from the lens of ESG due diligence? Is there anything you can share from the real world with us?
Sure. So yeah, I think it's quite true that even for the same corporate, they may have different score, from different ESG rating agency. I can't do much on this because I am not the rating agency. But definitely the trend that it happens. The different agents. Because why was that? Because I think different agencies, they have their own methodology and mechanism to assess the ESG rating. So particularly if they may classify, the first thing they may do is to classify the industry or sector they are. So if they classify different things, then the whole the material factors may be difference. So that's why I think why I would say that first of all, why there is a difference between the scoring amongst different agencies, because of the sectors they have chosen. And of course, different methodologies they have chosen. So that's why. So, and then you ask about, how does it come to a reality? So do we heavily rely on those agencies scoring? I would say not necessarily. We only normally take it as a okay. Well, the first stage, when the buyer want to identify, a target, first thing they will look, of course, is the screening of by the ESG scoring. So it's easy, quick and easy for them. But I think I would say that it will only look at the scoring, for is a preliminary, one of the reference only. So that's why we need ESG due diligence to look more deep dive, what happened to the corporate. So because as I mentioned, for ESG due diligence, the main purpose is to understand the targets, the resilience, whether any relevant risks and opportunities that they can capture. So when we do the deep dive of ESG due diligence, we can really look into the material metrics, material topics of the corporate. And then at that time, we use those score as a reference to try to make a peer, assessment or peer comparison. So I would say that, the score is quite useful to have a preliminary overview of the target, but it not necessarily we solely rely on it, because, and I would say that, people may say that, oh, ESG diligence is the same, we just copy and paste. But I would tell you this is not the case, because even, well, whatever target we have, they may have different industry sector. They may have different material ESG factors relevant to them. And also they may have different locations, different products, different customers, supply chain, So because when we look at the ESG diligence, we look at from the supply chain to the end customer, the whole, business cycle. So that's why I will say that, the rating agent know, despite that they are different, it will only act as a reference. So the deep dive due diligence really help, to tailor made to the local and requirement. And we will also, when we compare the due diligence result and the methodology, because we understand what the rating agent's methodology behind, then we can try to match, what is, relevant to the corporate, or what industry sectors, find the right, peer comparison. So that's the way we use those ESG score. So hope I answer the question.
Yeah, that's useful. So no, definitely there is more to do in the ESG due diligence space. So going back to Andrew, and maybe not even the last question, but also you talked about the sustainability performance targets, the SPTs, and someone in the audience was asking, so how do you make sure that a company is progressing as they are stating that they're doing? I'm not sure whether you're probably not using for every assurance a Big Four company like EY. How do you go about them in terms of tracking, monitoring the performance of these corporates, whether they are, well, doing what they said they would outline to do under the SPTs?
Yeah, so I can say that certainly we don't use the Big Four for all of these loans, but we use some sort of an external verifier to help us with that. So we're very much against self-policing or self-verification of performance levels against those targets. So in the loans that we do, there will definitely be that requirement to seek external verification. So if a borrower said, yeah, I know you've set those ESG targets for me, I have met those ESG targets, there will be a requirement to seek external verification, whether it's on a limited assurance or reasonable assurance basis, to ensure that indeed the borrower has met those targets according to what they have said. Only then do we adjust the interest rate accordingly.
Got it. And those external verifiers are selected but approved by you, selected by the company but approved by the bank, I guess, sort of endorsed at least.
Yeah, exactly.
Okay.
Yeah, and it could be the Big Four, it could be some of the ESG, some of the ESG rating agencies do provide that as well, and so on.
Got it. So no, that's good to know. Get it clear on my radar a bit, I guess, with enforcement actions that you get to choose a verifier. Let me stick with you, Andrew, for some other question. I mean, we talked about the banks, we talked about the corporates. I mean, we have the regulators and policymakers as well. And to really foster the sustainable finance market, what do you think, or what's your wish list that regulators and policymakers should do to incentivize this market? Well, maybe let's stick with Asia for now. Are you seeing any interesting developments with policymakers on the move and how they support or how they should support banks and corporates in terms of driving much needed capital to sustainable finance?
Yeah, that's a very good question, because if I look at the state of a company now, you're kind of being pressed on all sides if you're not already pursuing sustainability. You have your shareholders, and then I think there was one presentation earlier talking about the number of shareholders that they've signed up for the PRI, and they are constantly demanding their portfolio companies to be more sustainable. So you have shareholders who are pushing very much. You have banks like us, and I talked extensively just now about how banks are concerned about their borrower customers becoming more sustainable. You have the regulators. I think it's very clear now that regulators show they're at different speeds, but they're all going in that same direction of possibly more regulations, more oversight into the companies becoming more sustainable, about publishing their GHG emissions, for example, or undergoing stress tests. As banks, we go through stress tests on what the climate scenarios will do to our balance sheet. And then you have customers like you and me. You know, I bought an electric car a couple of months ago, and that is the best demonstration of voting using my wallet. And if you are a automotive company that doesn't have an electric car in your menu of products, then you have to be worried, because people like me, we're starting to compare price and quality, yes, but we're also starting to bring environmental impact into the consideration as well when we buy products. So the customers as well, and lastly, the employees. Employees no longer just work for the best paying company. Sure, you know, all that matters and gets weighed into the overall considerations. But more than that, the generation now looks for companies to work where there is a clearly demonstrated environmental and social purpose. So being a sustainable company means that you can cast the widest net to the talent pool that's out there. So I think as a company, you're kind of pressed to pursue sustainability, even if you're not a believer in that, just because of all the other stakeholders forcing you or compelling you to do so.
Got it. No, thanks for sharing that as well. So Sammy, we if I'm a company and I see an ESG risk, but I still want to acquire the company due to other strategic operational benefits, what would be your recommendations that this company, so the buyer, should go about this, even though I know that the target has some ESG risk flaws, etc.? How would you go about doing that, Sam?
Yeah, that's thanks for that. That's always a question the buyer asks us. Okay, if I ask you to do the ESG diligence, I really like the target. They have great, IRR, and financial returns. Will your ESG due diligence report, stop me, a deal breaking? But I would say that first of all, it's a commercial decision. It's not my desire, but I can tell. To be honest, most of the buyers nowadays that I encountered, still regard as take the box exercise, because they say that, oh, sorry, my LP, require me to have such a requirement. I would say that, but hopefully this is not the case for long. So you're quite right. Nowadays, I don't see much, ESG due diligence. If the negative, ESG performance will become a really deal breaker or no deal exercise, for the buyers. Unlike those financial due diligence or legal due diligence, tax due diligence, I think you see if you identify anything about, the financial or legal or tax matters, definitely they will not go for it. But I can see that at this stage, ESG due diligence still not yet a deal breaker. So, but if it happens, how can we, comfort, the buyers for this if they still want to go ahead, So I would say that normally we will ask them, to set KPI. Because we have in the due diligence, we should be likely to identify, what the material topics that they are lack of, and then what actions, the remedial actions, they should be taken to improve the performance. But I think except, taking into account those factors they are aware of, they should continue monitor it and evaluate it. Maybe set the KPI, for the targets. Keep on monitoring the KPI for them, and then during the post, merger, acquisition process, they need to ensure that the management, they take into account those factors. In the extreme case, I will also suggest, the buyer to insert, certain conditions in the S&P, like covenants or conditions, or at worst case, negotiate the price a bit down, if the target, have deficiency in this, because long-term wise, if the ESG performance, will ultimately erode the short-term return, for the buyer. So that's why that may be the case, if in case the buyer still interested to do it. So I think it's a continued monitoring evaluation process, to ensure that the long-term value won't be deteriorate, to as compared to the short-term goal. So that's what I would suggest, the buyer to do in I think similar to those divestment. I think a lot of questions are asked Andrew as well. Oh, if should we just throw away, all the non-ESG, investment? I think this is not the case, right? So we just maybe help the client to transit it, to be more ESG compliant, to be more, ESG integrated in the operations and strategies. That I would say is the solutions, for this case. Yeah, it is, if it is against the financial, impact. Yeah.
So definitely a risk versus reward, how you create value, how you structure the deal, just take all that into account. Andrew, there was a question for you from the audience, I think also from Singapore, Peter Lau. He is asking about, so now that we move probably from statements to real life application of sustainable, what is the difference in business basis points for the one and the same company for a let's say green loan versus a typical loan? Just how much is that? I mean, I understand that for taking on more constraints or well, promise to do better, what is it really in terms of spreads for them? What's in it actually? Just an indicative idea. I know it depends per credit rating as well.
Well, I think for this question, it might be instructive to look at the bond market, because you have quite a few issuers, especially if I remember correctly, Germany, sovereign. So they had issued a green bond in September 2020, and it was together with a conventional bond as well. So the two bonds have exactly the same characteristics, obviously the same issuer, same maturity as well. And the only difference was that one was green and the other one was conventional. And I believe it was issued with a 1 bp greenium, as we call it, premium, but because it's green, so we call it greenium. So it's a 1 bp greenium, but throughout, that was during the primary issuance, but throughout secondary trading since 2020, I think it's widened to as much as a few basis points. I mean, I haven't been checking or following very closely, but probably as wide as 5 basis points. So what is sort of indicative in the bond market could also be replicate or being sort of applied in the loan market. Banks are more enthusiastic when it's a green loan or a sustainability linked loan compared to a conventional one. Now, will some of that increased enthusiasm translate into cheaper funding costs? I think the chance is good if I look at what all the big targets that banks have published out there about how they plan to mobilize X billions of sustainable finance transactions by this certain year or that certain year. So I think there is definitely great enthusiasm on the part of banks.
Got it. And learned that word greeniums as well. So that's good for me as well. Another question also for you, Andrew. So I was just thinking, nuclear energy. I was should that be included in green? It's well, it's green. It's what are your thoughts? I mean, I don't know whether you have any real credit application with that, but I'm just curious. Nuclear, what's the banks? Well, maybe not the bank. What's your view, I guess?
Well, they are debating now in Europe, so it is a topic that divides opinions, not just in Europe but all around the world, and the jury is still out on that. But I think for those who argue that nuclear should be included, I think they're looking from the lenses of, okay, there's no GHG emissions. It helps in the global fight against climate change. So it sort of takes the criteria. But if you look at the EU taxonomy, there is that one set of criteria, but there's also the second and third set. And the second criteria, which I'll draw our attention to, is that part about do no significant harm. So the idea is that, yes, a business activity helps achieve one environmental objective, but it must not come at the expense of the other environmental and social objectives. And I think that is the part that still has that nuclear still has quite a few question marks over, which is that part about ensuring that the other environmental and social objectives are not compromised. So I think that part still needs to be critically examined and evaluated, and the necessary safeguards need to be put in place should nuclear be considered as green. So that will be what that is my view on nuclear.
No, that's very useful. While I ask the audience for any last questions, there's an open question to Sammy and Andrew, and any recommendations to, maybe it's too broad of a vision, to accelerate the whole decarbonization journey in our Asian economy. Any recommendations, either with your hat on from EY as a partner in M&A, or from you, Andrew, as a banker driving finance? In my view, it's probably also ecosystem partnerships between policymakers. Any recommendations in general, or pointers for the audience as a closing remark, basically? Maybe Sammy, if you're ready.
Sure. To be honest, I would say, because maybe we step back, I will share some experience. I talked to relevant regulators, about, I think, to be honest, it is quite difficult, for the corporates, to only think of, ESG. I need to be frank on this, because, for example, I'm the Sustainable Finance Working Group in Chambers, and the SME just told me that, oh, it is not not my business. It's big corporate. I need to survive. I think this is quite true. For example, like the sustainable finance area, I think the it will be both-sided from the government and from the regulators and from the corporate as well. I always talk to the regulator, sometimes you need carrot and stick. You cannot just, a disclosure, maybe some of the stake, if they have disclosure requirement, they try to comply, and then everybody try to work towards it. But on the other hand, you also need incentive to stake, for example, like sustainable finance. In that, FI also, complained to me, that, oh, we did it, out of our own pocket, to have lower interest rate, but there's no incentive, for us to do it. Yeah, we still need to make profit, and we still need to meet our KPI. I quite understand it. So that's why I think a lot, can be done, from regulator, the incentive, like the some grants or some tax concessions, or even for FI, can be on reduce the capital reserve or increase the LTV. A lot of can be done. So I would say that once the regulator or government have a big pictures of carrot and sticks together to motivate the whole market, and then the corporate definitely follow. And I believe the evolve of the global requirement, as I explained to the client, if you want to do business, because I think Europe is taking it very seriously. You want to do business with other places that are stringent requirement, the carbon tariff may be imposed as well. So you need to keep your space, to keep your pace, to up to those requirements. So I would say that it's both sides, from the top, from the government, and also from the corporate, to try to really see through the long-term value of integrate ESG into their operations and strategies. So I think, yeah, that's what I think about the general observation.
And thanks for sharing that experience with us, Sammy. And any
I think the part about can the regulator do more, and Sammy alluded to earlier about having some capital incentives, so maybe more favorable capital treatment for green assets on a bank's balance sheet compared to conventional assets. I just want to sort of strike a different tone with that, because I've heard a lot of suggestions on this front, and I think it's quite rational, right? Because if we want banks, we want to incentivize them to originate more green and sustainability assets, having favorable capital treatment certainly is one good method of doing so, I think. But we just want to tread carefully with market forces here, because and I just want to clarify that I'm all for improving sustainability in the financial system, but we have to be careful of unintended consequences, because once you start having different capital treatment, then you're trying to sort of distort risk and reward a little bit. And maybe the argument to have more favorable capital treatment would have been stronger a few years ago, because now we're really seeing this whole movement of sustainable finance and sustainable investing. So there's no shortage really in interest in green and sustainable assets. So much so that I mentioned we are starting to see a greenium in the market, a premium for ESG assets. So we already see this slight preference. Do we want to continue to tilt further this balance, which could risk over exuberance? So the best sort of analogy that I can draw to is the 2009 GFC. It all started with the subprime crisis, if we recall. And the subprime crisis, you could argue, is sort of beneficial from a social equity perspective. Somebody who couldn't previously qualify for a mortgage, now because of subprime products, now they can qualify for a mortgage and own their own homes. It's great for social equity, but look what it resulted in terms of the unintended consequences. So I think we do want to have to be careful with tempering with the risk and reward equation. But don't get me wrong, I'm all for doing more to combat climate change and improve social equity, but we just have to be careful not to do it in a way that generates unintended consequences.
Yeah, great balance to be seek. Yeah.
Correct.
No, perfect. Thanks to both of you. I think we're about time. Really, thanks. It was good for me to hear both from the professional services firm's perspective, from the financial services firm perspective. Really, thanks for taking your time for showing the audience. I think it was good. We have more than 200 people here today. And I think there were some questions coming from the audience, which I found interesting as well. And enlightening for me. I learned different things. So really big thanks to you, Sammy and Andrew. And I hope we'll continue this dialogue. And hopefully in a couple of years' time, we see more developments in the transition journey. Really thanks for your time. And I hand the microphone back to Professor Wu to say some final words.
Thank you. Thank you, Professor Lapman. Thank you for hosting the panel discussion. I also learned a lot from the professional perspective and industry perspective. Today we have three very important, interesting, and timely topics, right? Professor Zhan talked about how the ESG affect the option market and provide the academic evidence. And Sammy talked about the importance of ESG in MA, and Andrew, touched the sustainable finance from banking perspective. I think that all are very insightful. Thank you for sharing. Thank you all. So this is almost to the end of our seminar. I would like to also thank our collaborating organization, HKIRA. And just to remind audience, we will continue our past seminar. So this is our 11. We will continue 12 seminar, maybe August or in September or August, okay? And at the end of the year, we will have a big conference, okay, which will cover more topics and more interesting issues for the final conference, pretty much in November or December, okay? Welcome all of you to join our future events. So this concludes our seminar. Thank you again, and hope you have a nice day.
Have a good day, everyone. Thank you. Thanks, Sammy. Thanks, Andrew.
Bye-bye.
And thanks, Carol and Helen, for organizing this. Thank you.
Thanks, Carol, as well.